Investors buy options to profit from stock moves, ideally closing for a profit afterwards. But options lose value as they approach expiration. So investors that bought calls or puts have a limited amount of time to be right. Options that finish out of the money at expiration are worthless. Options that finish in the money are worth the difference between the strike and the stock price, with any additional time value now gone. Because options need a move, there's a less than 50% chance that an option will be worth more at expiration than when it was initially bought. Despite those odds, investors buy options because of the chance for outsized returns. Options can also be sold short. Here, the investor wants the option to decrease in value. An option finishing out of the money and worthless is an ideal situation for a seller. Obviously, if buying options has a probability of less than 50%, selling options has a probability of profit of greater than 50%. However, outsized gains are not possible like buying a call or a put. The credit received is the most that can be made. There is no extra credit for how much an option finishes out of the money. And the risk of being short a call is infinite. It's difficult to succeed in options if the investor is only buying options, and it would be nerve-wracking to most investors to simply be short options. Therefore, most seasoned traders do both, and many do it simultaneously. Option spreads have some differences with outright options, but the core concepts of buying for a debit or selling at a credit remain. When buying, the investor wants the stock to move their way, and for their spread to increase in value, ideally to its maximum possible value. When selling, the investor wants the spread to decrease in value. They want the entire spread to finish out of the money and worthless. To illustrate, let's use a $10 wide call spread, trading $4. Buying the spread risks $4 for the chance to make up to $6. It can be worth anywhere between worthless and $10 at expiration. Selling that spread is simply the opposite side of the same spread. It is risking the $6 of the spread to try to make the other $4 if it finishes worthless. And if it finishes worthless, the investor collects the entire credit, the $4. Options AI gives straightforward access to widely used strategies like call spreads, credit put spreads, butterflies, and more. In the following videos, we'll detail why institutional investors favor spreads and how an investor might utilize those spreads in their everyday investing.
Trade on a new breed of brokerage. Trade smarter with Options AI.